Thank you once again for joining us this evening. We hope that you're doing well. So, this evening we'll have an insightful and a useful webinar for all investors and potential investors. We're going to look at an analysis of the local and global economy. We'll discuss risks. We'll also discuss expectations and investment opportunities. So, feel free to ask your questions. Feel free to grab a notebook and get some few insights from our experts. So I'm going to go straight ahead and introduce our speakers for the day. So we're going to start with Ronnie. Ronnie is an economist and a professional investments consultant. Currently, he serves as a senior research analyst with the IB Axis Africa based in Nairobi. So Ronnie graduated with a first class honors bachelor's degree in economics and finance from Kenyatta University. He's also a certified investments and financial analyst holder. In March of 2023, Ronnie won the National Best Candidate in Portfolio Management Awards by CASNEB and the Institute of Certified Investments and Financial Analysts. This is ICIFA. So Ronnie's economic insights have been featured numerously in newspaper publications, including the Business Daily and also Bloomberg International. He's also an economic correspondent for local and some international media houses such as KTN, K24, and CNBC Africa Business News. Ronnie has a great area of expertise from equities and fixed income analysis across East Africa's financial service industry. So welcome, Ronnie. We are delighted to have you in this session. We also have Alex, also from AIB Axis Africa, who is a graduate from the Catholic University of East Africa. He pursued a bachelor's degree in finance and worked at Kenya Industrial Research and Development Institute, after which he joined Jan Africa Asset Managers before joining AIB Axis, where he's currently at. He serves as a research analyst for AIB Axis and is equipped with skills in securities research and financial analysis. So we're going to be learning so much from Ronnie and Alex. So at this juncture, I'd like to welcome Ronnie and Alex to start the session. Over to you, Ronnie.
Thank you very much, Amy, and good evening from wherever you are. I trust you had a fabulous week so far. I'd like to welcome you all to the AIB Axis Africa Quarter 2 2024 Investment Outlook, alongside my co-analyst Alex Sanja. We'll be taking us through the macroeconomic outlook, starting on a global perspective and funneling it down to the Kenya situation, before handing over to my co-analyst Alex to take us through the equities outlook. I'll then come back to wrap it up with the fixed income outlook and portfolio management investment implications for the year ahead. All right, so let's begin with a macroeconomic overview of 2024 so far. I think 2024 has, or it continues to demonstrate that volatility is the only constant. As the global economy is still grappling with recovering from the shocks of the pandemic, added to that, we had the Russia-Ukraine conflict that triggered cost of living pressures, prompting central banks around the world to tighten interest rates. That has come with a lot of pressure on households and corporates. The business environment has been pretty challenging. Even the broad economic growth has been on a downward trajectory. The slowdown has been more pronounced. If you look at global growth, averaged at 3.2, less than 3.4% recorded in 2022. But we are still seeing some bright spots in 2024. We are noticing widespread disinflation. That is to say, we're noticing the rate at which prices are increasing has been cooling down over the year. And we attribute this to a number of forces. One, we're seeing a more resilient consumer, despite the barrage of shocks that the consumer had to contend with. Consumer spending is still holding up to close to pre-pandemic levels. That in itself is a signal of confidence. And also the fact that this disinflation, it's almost as if it's a positive spiral, if I may, of improved confidence leading to lower inflation expectations over the medium to long term. Uh, However, yes, the shocks or the legacy effects of the pandemic and the geopolitical tensions are still at play. But the global economy, from our point of view, is normalizing into a context, albeit not normal, yet we're seeing the balance of risks has tilted in favor of a global recovery. I think another aspect we're noticing is that global growth is still divergent across regions, surprising on the upside in several cases. In the US, for instance, there was much talk around whether the US will enter a recession. Fortunately, because of the consumer exceptionalism, we noticed growth remaining or surprising on the upside in that case. However, this picture is not uniform. Peers such as the United Kingdom slid into a technical recession late last year. However, we noticed in the emerging markets picture, countries such as China, they were able to realize a rebound in growth driven by stimulative monetary and fiscal policies to stimulate economic growth. So that has been positive. However, the risks we have seen emerging in terms of the impact of geopolitical tensions on slowed global trade. And one of the major themes we've highlighted in our report is that given the woven interdependence of the global economy, uh, the risks from geopolitical tensions, such as the one expanding in the Middle East region, not only does it risk or portend supply chain disruptions, such as the one we've seen whereby ships are being rerouted away from the Red Sea region around the Cape of Good Hope. That has led to 3.6 percentage point decline in global trade. And it is projected that that slowdown in itself has a lot of negative spillover effects for global growth going forward. However, the positive we can take so far is that there was less carrying and there is greater optimism ahead, despite the risky environment we are navigating. In terms of growth prospects, we saw global GDP again slow down to 3.2, down from 3.4% a year prior. However, this growth was less scarred than initially projected. And this was attributed to, again, consumer exceptionalism, consumer strength. On the demand side, we saw higher private and public spending, predominantly supporting growth. And on the supply side, we saw stable commodity prices coupled with resilient supply chains support growth overall. In terms of the major themes we expected to shape 2024, one, we expected geopolitics to keep markets guessing. We pointed out that the expanding tensions in the Middle East region would threaten and are indeed threatening to slow down global trade. And not only that, we're seeing price shocks emerge in the form of, for instance, over the past 5 months, we've seen a crude oil price rally away from the 2023 December low. So that is another shock that is likely to funnel through across emerging and frontier economies. We also saw, because of the ongoing set of elections across advanced and emerging markets like the US, UK, Russia have already done the elections. India are still doing their elections at the moment. We are expecting that fact that we have elections. We expect many governments are likely to increase their spending, perhaps more than is necessary. And that presents, again, upside inflation shocks from our point of view. The second thing we expected, the growing burden of higher for longer. That is to say, the element of interest rates remaining higher for longer has wrought a lot of financial distress for businesses and households alike. We're seeing a rising stock of non-performing loans across the banking sector. And what's more interesting or concerning is that despite the disinflation you're seeing, central banks are still reluctant to easing, and understandably so, because we're seeing inflation again start to tick up. In the US, for instance, March inflation data came in higher than expected. So that again delays the expectation of interest rate cuts. And now that shows us that we are still in that murky space whereby we are still not out of the woods yet in terms of tackling inflation. And in terms of asset class outlook, we expected widening divergence, and true to it, we saw equities, for instance, record stronger performance, yet highly dispersed across and within sectors. But we attribute this to a more resilient or stronger than expected corporate performance, despite the shocks we had last year, and also prompted by expectations that interest rates would decline. Investors were nudged to start divesting away from cash and bonds back into equities. On the fixed income side, we saw fixed income assets experience higher rate volatility, and this was driven by mixed expectations on the path of interest rates. So some players were expecting rate cuts as early as March. Some were expecting rate cuts as early as June. Now it's even questionable whether we're going to have rate cuts as in June. So such we saw bond yields decline and then soar back up to where they were. And that gave us a mixed picture for fixed income assets. For now, perhaps we can shift gears to the Sub-Saharan Africa outlook, where I think, broadly speaking, we saw the region experience a slowdown to 3.4%, down from 4% in 2022. Slowdown pressures were a bit more pronounced in Central, Southern, and West Africa, largely on account of lower consumer spending. And also we had, especially in West Africa last year, bouts of political instability in the West Africa region. In South Africa, we had the aspect of power cuts and the load shedding that was prevalent for the better part of last year. So that weighed heavily on growth, understandably. However, Eastern African nations were emerged relatively unscathed. Growth in March indeed surprised on the upside, even for Kenya case, as you shall see in the coming slides. In terms of exchange rates, we saw mixed trends pointing to higher volatility across the region. As we shall see in our report, the Kenya shilling was indeed the largest, or recorded the largest currency appreciation gains relative to the dollar, whereas the Egyptian pound and Nigerian naira came under pressure. Of course, that was monetary policy induced, with the Central Bank of Egypt and Nigeria deciding to devalue their respective currencies, to tackle the sky-high inflation that derived largely from importable goods. And lastly, we saw, broadly speaking, shifting fortunes across international debt markets. So whereas while we saw credit spreads between investment-grade bonds and emerging and frontier market bonds remained relatively volatile, we saw some silver lining for countries such as Ivory Coast, Benin, and Kenya, who were able to reaccess the international debt markets for the first time in about 15 months. The entire of 2022, no country was able to float a Eurobond. Kenya, for instance, tried to float a Eurobond in 2022. However, the market rates were so high as 22%, so it was unfeasible to access the market at the time. But this year, as we shall see in coming slides, Kenya was again able to tap these international debt markets. However, now because of the fiscal consolidation, we're seeing African governments across the board raise consumption and trade taxes and marginally trimming down spending in order to rebuild the fiscal buffers. Now we can shift gears to Kenya. So on the Kenya front, we saw Kenya's real GDP grow by an estimated 5.6% last year, compared to a growth of 4.8% in 2022. And this was largely spearheaded by growth in the services sector, more so specifically the tourism and financial services sectors, which bounced back to pre-pandemic levels. We also saw, interestingly, the industry sector recover or remain or display a lot of resilience, more so than it was initially anticipated. And we think that momentum will sustain following now we are phasing off the overhangs of the political cycle. So we think growth will accelerate further to 5.9% in 2024, driven by recovery to the manufacturing sector as the disinflation we are witnessing helps stabilize consumer real incomes. However, we still have risks such as the risk of elevated interest rates weighing on growth and crowding out of the private sector, as well as the volatile commodity prices, which risk again disrupt or marring the inflation picture. On the inflation front, we are seeing we are on a risky path to stability. And while on the one hand, we saw price pressures ease, signaled by the decline in headline inflation to 5.7% as of March this year. And this coming on the back of softer food prices as food supplies increased during the year. And also we saw fuel inflation decelerate marginally or sharply, driven by pass-through effects of the exchange rate strengthening, as you may recall, in February this year. However, we know the monetary policy makers are keen on lowering inflation to the 5% target before they can think about lowering interest rates. We think this path to the last phase towards 5% is all the more riskier, given the developments in the international space. Given the geopolitical tensions in the Middle East, the risk again disrupting supply chains that are fragile and recovering. However, we think should we experience further exchange rate strengthening, the pass-through benefits will be more than enough to take us to 5% by the half of the year. Coming on to the exchange rate picture, we saw the exchange rate or the Kenya shilling reverse its fortunes in the first quarter of the year, driven by a mix of domestic and global factors. One we saw in the months leading to February this year, the CBK introduced the electronic matching system for the interbank foreign exchange market and adopted the CBK published exchange rate based on the weighted average of all interbank transactions executed on the previous day, instead of the previous regime where the CBK would quote exchange rates based on indicative rates provided by major players in the interbank market. Added to this, we around mid-February, we saw the CBK open a conditional 1-week buyback on Eurobond buyback program that was conditional on refinancing using another 2031 amortized Eurobond. We think the proactiveness of how this Eurobond was refinancing was executed, was very critical in casting away apprehensions surrounding the balance of payments position. So, as such, we saw a decisive pullback in the exchange rate, or a decisive boost of confidence that triggered that pullback in the exchange rate. More recently, however, we are seeing the exchange rate again start to kind of stabilize at 130 levels, and again starting to pick back up towards 135. But I think over the medium term, we expect range-bound volatility. That is to say, we don't expect sharp depreciation as we saw in 2023. We're looking or working with around plus or minus 5% from current average rates. So oscillating from around 129 to 139. That's the range we think the exchange rate will trade for the remainder of the year. However, we think it will remain more volatile within that range, driven by mixed expectations around the balance of payment status and also concerns around fiscal sustainability. If you look at our Forex reserves improved marginally to $7.1 billion, enough to cover 3.8 months of import cover. So that was an improvement indeed from December, where the reserves were only enough to cover almost 3.5 months. And we attribute this to, especially in February, we saw a huge uptick driven by huge foreign interest in a tax-free infrastructure bond issue. That was the 8.5-year bond that recorded an oversubscription of over 400%. And also, looking ahead, we expect these foreign direct investment flows to persist, driven by high real yields. If you look at our report, from our analysis, we identify Kenya having among the highest real yields on the continent. So that has driven the flows we are seeing. In as much as they are debt creating flows, they are supporting a balance of payments neutrality. And also because now the new structure that the Eurobond took on was amortized. It now allays or dispels away dollar liquidity risks over the medium term. So I think that's a positive story or outlook for the Forex Reserves account. On the fiscal side, look at the table there. Maybe the highlights you can pick is that Kenya's fiscal performance for the first 9 months of financial year 2023-2024 stood at 82% on the revenue side and 84.1% on the expenditure and transfer side. So that is to say the government has been lagging behind its target. By the first 9 months, the government ought to have collected 1.9 trillion, but it had only managed to collect 1.6 trillion Kenya shillings in revenue. On the revenue side, on the financing side, rather, we saw domestic borrowing and external borrowing trail largely again below the target. However, domestic borrowing was well performing this year, driven especially in February. It was more than enough to offset future borrowing targets. And this comes on the back of a revised supplementary budget one of 2023-2024, which increased tax revenue targets and also expenditure targets by 6%. That in itself led to a widening of the budget deficit from the projected 4.4% of GDP to 5.3% of GDP. On the Eurobond market, on the external debt market, we're saying calm after the storm. And if you look at the graph on your left, the calm is signaled by the decline in the Eurobond yield curve from the black line to the orange line. So in as much as our debt service, the ratio of debt service to exports ratio was projected to average at around that 1.1% in 2024, up from the average, the recommended ratio of 15%. We saw, especially in February, following the refinancing of the Eurobond, we saw yields decisively decline almost instantaneously to single-digit levels. And we saw now the Eurobond yield curve normalize following that successful refinancing. It was successful because it was overly subscribed, and the proceeds from the new issue were fully used to offset 70% of the 2 billion bullet that was expected in June. That was already settled in February. So what is remaining is only 30%, which we believe the central bank should be able to clear in come June this year. And on the monetary policy, to wrap up the Kenya outlook, we are asking, is it finally time to ease interest rates? We know that the Central Bank of Kenya's Monetary Policy Committee tightened the central bank rate by a further 50 basis points to 13% in February. However, looking also at the Central Bank of Kenya CEO survey of March 2024, we noticed that not only is current inflation declining, but also the expectation that inflation will trend downwards over the next 3 to 6 months is also on a downward path. That was one of the key findings of the CBK CEO survey of March 2024, pointing to rising confidence that the current interest rates are adequate in ensuring long-term price stability. And we think this should now support the case for the central bank to consider lowering interest rates. However, we know because we don't live in isolation, the central bank will also be monitoring global developments and the implications on price stability domestically. So we think the CBK will adopt a wait and see approach as inflation trends towards the midpoint 5% we talked about earlier. However, I think also that the recent strengthening of the Kenya shilling will unlock a lot of pass-through benefits to price levels, at least to a better extent than we saw last year. The reverse was more costlier. Indeed, even studies from IMF show that the pass-through effects of exchange rate depreciation are 8 times as worse than pass-through benefits of the same amount in the opposite direction. So I think with that, I'll hand over to my colleague Alex to take us through the equities outlook.
Good evening, everyone. I'll be taking you through the outlook today. Level road for equities. So there's a migration back as there's widespread expectation of interest rate declines in developed markets, which has triggered a divestment from cash, near cash back into equities. This is because of the inverse relationship between equities and interest rates, such being the higher the interest rates, the lower the valuation of equities, and vice versa. We have expectation of delayed interest rate cuts, with certain countries like Switzerland having already cut their interest rates. But there's a wait and see approach here, as tomorrow the Fed is having a meeting to discuss the US interest rates. So we're waiting to see on what it is that meeting results in, to give us a clearer picture on the way forward. Increased sectoral divergence. Multi-sectoral divergences persisted across the listed equities markets, even as segments continue to shake off legacy effects of the poly crisis. We've just come out of the COVID pandemic, where many industries locally, that is, were starting to recover. Then the Russia-Ukraine conflict started, and the Israel-Gaza conflict started as well. And this has marked the water a bit for many local industries, but there is recovery for very many industries. A good example of that would be the banking industry, which with most banks reporting very positive results. So right now we're entering into a regime of higher volatility, where we're going to see a lot of stock prices move both up and down. Large cap stocks prove their worth. The MSCI All Country Equities Index recorded a Q1 2024 average gross return of 8.3% in US dollar terms, accelerating from 6.8% in Q1 2023. We attribute this improvement to better than expected corporate financial year 2023 performance from large cap stocks. Here we'd mostly be looking at, this is in the local context, companies such as Safaricom, Equity, and Cooperative Bank, which have all had positive results, or had positive results last year, and there's expectation of better results from Safaricom as well. Position for recovery. Regional equities performance. So regionally, African equities markets recorded improved performance over Q1 2024 to to deliver an average return of 4.2% in local currency units, LCU. Nigeria posted the highest LCU return of 39.8% in Q1 2024, followed by Uganda and Kenya, which posted results totaling to 22.9 LCU and 22.8 LCU. Namibia was the most depressed market, posting a discount of 6.4%. Here we can see that the African equities have been recovering from their lower performances last year. This is mostly due to the recovery that we've talked about earlier, on very many economies recovering from the multiple crises that we've been facing regionally. The Nairobi All Share Index gained 22.8% over the first quarter of 2024, closed at 113.9 points. This outperformed the African median return of 4.2% in local currency units. Aggregate trading turnover improved 56.9% quarter on quarter to 18.51 billion shillings, driven by resilient corporate performance and broad expectations of interest rate declines.
So in terms of the top movers over the first quarter of 2024, we saw Safaricom top the charts with a turnover of 7.9 billion Kenya shillings to close at 17.75 shillings per share, presenting a year-to-date gain of 27.7%. And as you can see, it's highly correlated with above average foreigners' participation. So Safaricom recorded foreigners' participation amounting to 73.6% of the total turnover over the quarter. Equity Group came in second with a turnover aggregating at 4.7 billion Kenya shillings. To close at 47.15 shillings a share. That represents a gain of 40.1% as of March 2024. And in that place, we had KCB Group recording a turnover amounting to 2.5 billion over the first 3 months of the year, to close at 30 shillings and 5 cents a share as of March this year. That represented a gain of 37.2%. And uniquely here, we saw KCB was largely, we saw domestic institutional bullishness over the first quarter, driven by their drive to restructure their non-performing loan book and also to restore capital buffers to adequate thresholds. In terms of foreigner sentiment, we saw foreigners were largely bullish on select counters, notably East African breweries, where they recorded net inflows amounting to 269 million. They're also mildly bullish on KCB as well, recording net inflows amounting to 185.26. And in that place, Kenya Power at a mild 10 million. On the flip side, foreigners were largely bearish or net bearish on Safaricom. However, the intensity of the bearishness was much lower compared to previous quarters. So this is a much lower figure at 1.7 billion. In second place, foreigners are largely selling off or net selling off Equity Group holding shares, recording net outflows amounting to 440.86 million. And in that place, foreigners are largely bearish on Kengen, recording net outflows of 192 million Kenya shillings. In terms of winners and losers on the capital gains dimension, we saw Liberty Kenya emerge the best over the first quarter of 2024, recording a 48.5% gain, close at 5.5 shillings. Equity Group came second with a gain of 40.1% from December to March to close at 47.15. In that place, we had KCB Group, which also recorded an outsized 37.2% valuation gains to close at 30 shillings and 5 cents. On the flip side, we saw Home Africa shed the most, shedding 18.9%, Standard Group shedding 16%, and Nairobi Business Ventures shedding 14.8%. Fortunately, this quarter was very positive for large cap counters like KCB, Safaricom, Bamburi, and also Cooperative Bank, on the back of resilient or stronger than expected earnings. There are a number of counters where markets are still pricing in for positive earnings, like Safaricom, which, as Alex pointed out, are set to release their results in the coming week. And we think large cap counters are now rising to the occasion, driven by improved global sentiment for equities, and as such, these blue chips are benefiting from that reversal in sentiment. Unlike last year, where the broad sentiment was just put your cash in fixed income and settle the debate. Right now, fixed income assets have been very volatile, so the next best alternative was equities. And I think broadly, even as we'll discuss in the portfolio management implications, is that it is now becoming more expensive to stay in cash. And you say cash is king for only so long before you start to lose out to inflation. In terms of dividend picks, Umeme still retained its leadership on the dividend front, recording a dividend yield of 19.4% computed on its div prices as of December 2023. In second place, we had Standard Chartered Bank, which declared a final dividend of 23 shillings. In total, when added to the interim, it added to 29 shillings. That represented a dividend yield of 17.9%. And Kengen also came in that place with a dividend of 30 cents on the closing price of 2 shillings a share. That translated to a dividend yield of 14.9%. Can now shift gears briefly to fixed income. Our outlook for treasury bills and treasury bonds will be covered herein. So what did we see in the first quarter of this year? I think we can summarize in three major aspects. One is that we started to see yields decelerate and even decline on some segments of the yield curve. Interest rates, as we say, peaked and began easing following the government's move to refinance the Eurobond and the subsequent strengthening of the Kenya shilling. Those two factors combined delivered a decisive boost of confidence, not to mention the fact that inflation was easing as well, only added to the positive sentiment. However, the pace at which interest rates were easing was slower than expected, pointing to a cautiousness by investors to fast easing. And this, I think, was also driven in part by the Central Bank of Kenya strategy to start driving yields lower. We saw the CBK issue a 10-year auction at a predetermined coupon rate of 16%, when the previous infrastructure bond was issued at 18.46%. So the CBK was almost directing the market that, hey, the only way now for yields is lower. However, this has met with resistance as expected from investors. So that has a bit slowed down the pace of deceleration. However, the central bank is very determined, especially in the previous weeks where we saw the 91-day T-bill rate drop by a full percentage point. So that was again another sharp signal to the market that CBK will not accept higher for longer rates. And as such now, that informs the strategy they are embarking on to issue short duration and even long duration bonds at predetermined rates, and also their aggressiveness in terms of, or assertiveness rather, in terms of rejecting the aggressive bids, all in a drive to push yields lower. And thirdly, I think we saw a rebound, a sharp rebound, if you may, in secondary market trading activity. If you look at the graph there, secondary market trading activity soared 156% to 458 billion, driven by increased demand for the February 2024 infrastructure bond that was heavily oversubscribed. But a lot of the domestic institutional bidders were missed out because they were too aggressive in the rate they quoted. So I think that was what drove the acceleration in market activity. In terms of yields or the yield curve or the term structure of interest rates, we saw, as I said earlier, the yield curve peaked off its upward momentum because the whole of last year, the yield curve paced up from the green line you see here to end at the orange line you see. So that shows you interest rates were going up generally last year across the duration spectrum from the treasury bills, 91-day, 182-day, and 364-day, all the way to 23-year bond durations. However, that momentum has slowed down. So we are seeing the yield curve gradually correct. If you look at the spreads in the gray bars, we're starting to see 91-day T-bill rates slow down or come down. So that in itself is a signal that yields are now headed lower. And even if you look at our projection of the yield curve 6 months from now, we expect it to trade even lower, but not back to the normal curve. We expect still some disturbance along the short end of the curve, driven by the tug of war between the Central Bank of Kenya on the one hand and investors on the other, keen to maximize their real returns. So in terms of how long it will take to normalize the yield curve back to where we were around 2022, 2023, I think it will take much longer, especially given now that the key central banks around the world are considering keeping rates higher or even increasing interest rates. So that is an upside for reinvestment returns, but a downside for capital gains for bonds overall. And finally, portfolio management implications. So what are the investment implications from the investments as assumptions we've laid out? We think there are three key implications. Firstly, in the first quarter of the year, we encourage investors to stay selective. We are bullish on equities, but with a caveat that remain very selective, opting for fundamentally sound, quality, blue chip equities. And that investment priority paid off. As you saw in the earlier tables, the top gainers over the first quarter of the year were largely blue chips: Equity, KCB, Cooperative Bank, Bamburi, Safaricom, I&M. All the blue chips featured heavily on the top 10 list. We think going forward, we still prioritize the large cap counters owing to how discounted they are, yet fundamentally sound, or their prospects are very promising at this point of the cycle. Secondly, we think investors will need to be very proactive and dynamic in responding to changes in the risky business landscape. That may entail rebalancing your portfolios towards sectors that are outperforming, and also cutting down exposures to sectors that are underperforming as the business cycle evolves. And lastly, we think investors need to shake away their recency bias. So by recency bias, we mean that is the tendency of investors to prioritize or to use the past as a guide to the future. We know that past performance is not a guarantee of future returns. It is not a guarantee, for instance, that the exchange rate will strengthen by the same belt that it depreciated last year. So we essentially imply or we stress cautiousness as we navigate the business cycle. And also, we think now, as I put it earlier, staying in cash or the narrative of cash is king will no longer hold going forward. It will be increasingly expensive to hold on to idle cash in light of the opportunity costs that the market presents. And as we conclude, we think we have presented equities portfolio for 2020, for the remainder of 2024. We rebalanced the portfolio a little bit, increasing exposure to the banking sector, especially KCB, which wasn't in our portfolio in Q1, but now we've included it. We think there is still some price discovery to be made on the counter to 36 shillings, driven by their efforts to restructure the business towards health. We also we wanted to increase exposure to Safaricom in Q2. We think there's still some price discovery also to be made on Safaricom, given how discounted the historical price to book ratio is, with compensating prospects of improvement, especially in the Ethiopia case. Maybe Alex would delve in deeper as we head into the Q&A on the Safaricom case. And we wanted exposure to that price discovery as well. But broadly, we think this portfolio is designed also to help you, or the fact that we are rebalancing the portfolio, that in itself is a signal that we are also staying alive to changes in the business cycle. For instance, we've also cut down exposure on some sectors that we think have already priced in future earnings expectations. Insurance, we have reduced or trimmed down our exposure to insurance sector, and marginally also on the energy sector, because on the price perspective, we think prices will not be as favorable or volatile for, volatility is favorable for corporates to make money from changes in prices, especially for commodities with a low elasticity of demand, such as energy. So the price outlook is not as favorable. So we reduced our exposure or our outlook on energy. But all in all, we think the expected returns are favorable for investors. But we endeavor to give updates in our monthly stock recommendations, which we issue on our email and also WhatsApp channels. And also, as I conclude, we have a fixed income portfolio. And we think as interest rates begin to decline, we think investors should take advantage to extend their duration. That is to say, investors should consider taking up longer term bonds to lock in the already high yields for longer, and also benefit from the price rally that is set over the coming quarters. For income-oriented investors, we've ranked the top coupon-paying bonds by coupon rate, but of course, their gross of tax were applicable. Other than that, I think those are just the snippets from the AIB Axis Quarter 2 2024 investment outlook that I believe you will find very, very interesting and very engaging. Thank you very much.
Okay, thank you so much for your time and for the presentation that you give. I think now we're going to jump straight into the Q&A section. We have quite a number of questions. So Ronnie and Alex, you will help answer some of these questions. So the first question we have, Nixon is asking, When are dividends paid? Are they announced and paid at the end of the financial year? So maybe one of you can answer that.
Thank you. Thank you very much. So Nixon, dividends are paid on varying timelines. Each company has its own timelines on when it chooses to pay out dividends to shareholders. For instance, a bank whose financial year ends in December 2023 may issue a final dividend payable in April or May this year. And we also give out the timelines or the book closure dates, as well as the dividend payment dates in all our weekly equities reports. So you should find the specific dates when you are entitled to receive dividends. And also tying with your second question, are they announced and paid at the end of the financial year? Yes, yes. And also added to that, some companies can decide to pay an interim dividend. That is midway through a financial year, they can opt to pay out a portion of the dividend or portion of the total dividend they anticipate to pay out for that financial year. But also may add that it's not a must or not a guarantee that a company has to pay dividend. You will know that with equity investments, there is an element of risk. Now, depending on the longer term career or longer term objectives of the company, they can opt to withhold dividends for future re-expansion or for future expansion. So that may mean some companies may not pay dividends in some financial years compared to others.
Okay, thank you so much, Ronnie, for replying to that question. And Nixon, we trust that you have gotten your answer. The next person is saying, thank you for the presentation. I'd like to inquire if interest rates on T-bills and infrastructure bonds are projected to drop.
I think I discussed the interest rate outlook, and it applied both for bonds and treasury bills. I pointed out one case 2 weeks ago where the central bank reduced the rate paid on the 91-day treasury bill by 1% to 15% levels. So that in itself was a signal that across the board, both for treasury bills and treasury bonds, the CBK is keen on lowering interest rates.
Okay, thank you, Ronnie, for answering that question. Samuel is asking, could you please expound on index funds, how to join or how to buy?
Thank you, Samuel, for your question. I think the question around the index fund. First of all, in Kenya, we do have the only one form of index fund, which is the ABSA Gold Exchange Traded Fund, ETF, which tracks the price of an underlying commodity, which is gold in this case. However, in terms of whether the equities market has an index fund, the Nairobi Securities Exchange does not have an index fund that you can directly invest in. They only provide index measurements that you can use to compare the performance of your portfolio against. But there are some fund managers who endeavor to provide equities funds and bond funds that you can research more on and invest in.
Okay, I hope that whoever asked the question, it is well answered. So Mandela asks, if foreigners were bearish on Safaricom shares, is that a bad sign?
Okay, I think I'll also combine that with another question here I can see on Safaricom, where someone is asking, maybe Alex, you can take on this one. Why is Safaricom going down in price? Today it went as low as 15.75. And there's now the first question of, if foreigners are bearish on Safaricom, is that a bad sign? Maybe Alex, you could take on those two.
I'll start with the one about foreigners being bearish on Safaricom. The answer to that would be yes and no. As Safaricom, a large number of the Safaricom shares are held by foreigners, so their market movement moves its market value. So if they're bearish on it, the price tends to go down. No, if they're bearish on it, the price tends to go down, and if they're bullish, the price tends to go up. They've been bullish for a while since the year started, and we've seen its value going up.
Okay, thank you, Alex, for your response to that question. So Mandela again asks, what is dividend yield and how come Umeme had a dividend payout of 3 shillings, yet the highest dividend yield?
Dividend yield, it's a factor of the dividend paid and the price, the share price. So Umeme's share price is relatively low, and that's why 3 shilling dividend gives you a higher yield because its share price is low.
We hope that you have been answered, Mandela. So I can see some questions on how to get the slides. I think you can find this on our website. If you go to our website under research, you will find the Q2 investment outlook. So for anyone asking to find the slides, you can find them there. Okay. Wilson asks, on the Q2 equities recommendation, are they for someone looking to be earning dividends for long term, or are they for someone looking to hold them for some time and then sell them?
Thank you, Lancer Wilson. So our equities portfolio is intended to be very dynamic and responsive to the business environment. So we typically compose them with the outlook of 6 months to 1 year. And we evaluate their prospects in light of competing opportunity costs or comparing them with other alternatives. So the portfolio is a mix of both capital gains and also dividend earning counters. But we think also fundamentally they are also robust counters because we have, it's a blend of quality, dividend, and also momentum all in one. I hope that answers Wilson. There's one macro question here on what is happening to the Kenya shilling. What is its equilibrium and direction, and what is driving the depreciation? So the exchange rate, if you ask any economist, especially if an economist went to Kenyatta University, you never get a clear-cut answer on the equilibrium exchange rate. This is because no one has the crystal ball on such a figure. However, we use to infer the direction the exchange rate is heading is looking at variables such as changes in the balance of payments account, demand and supply in the interbank market, and also other risk factors like public debt and so on. But I think, as I discussed earlier in the presentation, we think the shilling is floating to around its true level. We don't think the exchange rate will depreciate to the pelt or to the extent it did last year to the 160 levels. But we think there's also more headroom for further strengthening, given the technical balance of payment surplus we expected to clock by the end of the year. We also expect a recovery in exports this year, driven by improved price levels, and the fact also that the government has been spearheading a raft of tax incentives. And for instance, they lowered the tax rate on multinationals from 37.5 to 30%. We're seeing classification of special economic zones. These incentives are meant to attract foreign direct investments into the region. And we think also the fact that government has also pronounced itself on possibly privatizing some of its state assets to the private sector So that implies an upside for the balance of payments account. So we think that those forces net will drive a strength more than a depreciation. But even if it depreciates, we think it won't be any more than 10% from current levels up to the end of the year. Thank you.
Okay, thank you, Ronnie, for answering that question. So Victor is asking, given that policy rates are higher than growth rates and have been this way for some time, which is technically recession, are non-financial firms likely to perform over the short and midterm?
So there's an expectation of recovery this year as consumer confidence grows. We're going to see more purchases being made by the everyday consumer, and this is going to drive higher revenues for many non-financial companies. Believe we talked about the CPI, which is Ronnie did talk about this earlier, whereby we've seen that there's an expectation of lower inflation, or rather of a deceleration in inflation, and this will lead to higher consumer purchases, or greater consumer purchases, leading to higher revenues for these companies, and so better growth than last year. I hope that answers your question.
Right. Maybe I can answer questions on the banking sector. There's one question here from Samuel asking, do you think the banking sector will outdo the 2023 performance this year? I think it's not the answer is not clear cut, given the fading hopes of interest rate cuts, which we are really expecting will drive a recovery in lending to the real sector and also an upside for financial securities. But given the risk, depending on the risk landscape, we still think the fact that the consumer is very resilient, and also the fact that banks are now rolling out the risk-based pricing. Again, here they are scaling up digital capabilities. We think all this net will leave the banking sector still at a better position, relatively unscathed from the risk landscape as we see it. So I think it will outdo the 2023 performance, albeit marginally. Another question on the banking sector I see, when do you foresee KCB resuming dividends payments, interim or final, from Justice? So broadly, we think KCB, from the interactions with management, they hinted at possibly resuming dividends by June this year, in the form of an interim dividend, following their move to restructure or withhold dividends last year in order to restore capital buffers. What do you think about Standard Chartered Bank? Do you expect a drop anytime soon? I think we've already seen a drop in Standard Chartered, driven by the lapse of the book closure date. So it's already trading ex-div or without the dividend. But we think there's still some price discovery to be made. It's a attractive entry point if you're looking to take up Standard Chartered. There's one here from Nicholas Akama. For long-term investment on shares, an individual should pick how many companies? So I think this varies depending on your risk profile and your initial investment capability or risk abilities. So it can be as low as, because now the minimum you need to invest in any company is the equivalent of 100 shares. So if you pick, let's say, a counter like Safaricom trading at 1580, 100 shares of that would be 1,580, but of course you need to account for transaction costs. So give or take 1,700. That also answers someone who asked about starting investing with 1,000 shares. But I think now it depends with your term horizon or your investment horizon. How long are you willing to set aside these funds for price discovery on the stock? So the number is give or take what you need to look at is your investment horizon and your willingness and ability to take on a particular risk profile that the company holds. Can local investors access offshore stocks? I think that's a good one. So at AIB Axis, we do have an offshore investment desk. So maybe I can advise you can email us on the email here, research@AIB Axis Africa. We will link you up with our offshore investment desk based in Mauritius. And also our head of business growth, Mohammed Yassin, will help or will advise on how we can proceed on investing in offshore securities. Someone is asking, do we still have infrastructure bonds being floated? So anonymous attendee, I think we do know that this is a decision at the power of the Central Bank of Kenya. So they are the ones who decide when and at what duration they will issue an infrastructure bond. Usually they issue an average of 2 in a year. So probably they'll issue one in September, October. But again, it's not a must. They can choose not to. Given the operating environment. Hello, do you offer bonds purchase? Patrice Mulindi. Yes, we do. At IB Axis, we do offer access to treasury bond investments. We give bidding guidance if you are buying a bond in the primary market or directly from CBK. Or also, if you want to purchase a bond or even sell your current bond holdings via the Nairobi Securities Exchange, AIB Axis is a reliable top broker in terms of the competitive transaction rates we offer and the timelines you're able to settle your bond transactions on.
There's one here, since you project Safaricom to go up 42%, should we just buy Safaricom and ignore the rest, which have a much lower return? So the answer to that is no. You should consider diversifying just to lower your risk, because these aren't guarantees and the market could disappoint. So always try and diversify your portfolio. Hope that answer that.
Wonderful. I'm seeing someone ask here on query regarding how do I unblock my account. So if you have a query regarding a blocked account or forgotten password, kindly send an email with your details to feedback@aibaccessafrica.com and the client relations team will respond to your queries promptly. Someone is asking, what of dollar cost averaging? Can you comment me on this? Caroline Mugambi. So Caroline, dollar cost averaging is the practice of lowering your weighted average cost of purchasing a particular asset in the event the share price or the asset price has declined. So for instance, if at all Safaricom if you bought Safaricom at 20 shillings, and because of, let's say, supply demand mismatches, the stock price declines to 15 shillings. But fundamentally, we think the counter has much better prospects for price discovery to even, let's say, 30 shillings per share. What you do is take up more of Safaricom shares at 15 shillings. This will have the effect of lowering your average cost per share that you bought Safaricom at. So if you had your first shares at 20, you buy more at 15. So the average cost of your shares comes to about 17.5. So that now gives you greater room for price discovery once the share crosses the weighted average cost. So if you sell even at 19 or 20 or even 25, you really realized tremendous capital gains based on the fact that you bought at a lower average cost. So all questions around dividend payments, we said we published that on our weekly equities note. So you should find the dates. You should expect to be, you should be a bona fide shareholder by the book closure date, if at all you want to receive the dividend.
Yes.
In terms of, maybe Alex, you can take on this. Do we expect increased turnovers on equities counter and also the indices? From Ronald Wani.
So market sentiment has so far been bearish, and we've seen an improvement in net inflows by foreigners. So the expectation is that yes, if the trend holds, then yes, we do expect higher turnovers for the NSE this year.
And there's another one, Alex, you can take on. Can you advise to buy Umeme or Kengen?
I'd say they're both good buys, but so for Umeme, it's a good dividend stock, and they're in talks, I believe, with the Ugandan government for an extension of their contract. So, but also there's also talk of an end to that. So there could be a lump sum payment at the end of that, sometime next year. Kengen as well, it's a good buy because it has stable earnings, and they're undertaking very, very many projects that will see the production levels go higher, and with electricity prices remaining stable as they are right now in the country, we expect stable earnings from both of these. So Kengen hasn't paid dividends as high as Umeme has, obviously, but they're both good buys. But I'd lean more on Umeme than I would on Kengen, but they're still both good buys. I hope that's answered the question.
Thank you for that, Alex. Maybe I can answer. There's one here, someone asking, where do I start when I want to invest in shares? So for equities or shares, if you want to invest in shares, the first step, you have to open a CDS account with AIB Axis Africa. Now the good thing is that now we have AIB DigiTrader platform. Now opening an account is very seamless. You can do it online. You don't have to make a visit to the office. You can fill in your details on the AIB DigiTrader app. You can fund your account electronically and begin trading on shares electronically in as fast as T+2 or T+3 days. For bonds, if you want to invest in treasury bonds or infrastructure bonds, treasury bills, the first step you have to open or ensure that you've opened a thou CSD account with the Central Bank of Kenya. And as you're opening, you can opt to select AIB Axis Africa as your preferred broker. This will enable you ease of liquidity in case you want to liquidate your bond midway through the life of the bond or the treasury bill, but mostly for bonds. And after you open your thou CSD account with the Central Bank of Kenya, we'll open also a brokerage account here with AIB Axis for purposes of us settling bond transactions on your behalf. We remove the hassle out of investing, and that's what we pride ourselves in being able to deliver for our clients. There's so many questions, very diverse questions. Someone is asking, is the Eurobond undervalued? I don't think it's undervalued. I think it's fairly reflective of the risk environment because they're still trading in single digits around 9% to 10%. I think that's fairly competitive given our risk profile and our the balance of payment status we are in. Do you have a basket of equities one can invest managed by AIB Axis? We do have an offshore basket of equities, an Africa Equities Fund and a Global Equities Fund with our Greater Axis Group Mauritius, which I said if you would like more information on, you can send an email to research@aibaccessafrica.com. But here in Kenya, we are yet to have such a product that avails you the opportunity to invest in a basket of securities. But it's something I think that is long overdue. Should be able to consider this idea going forward. What are the taxes that will be implemented if I liquidify my bonds? Currently there are no taxes applicable on selling your bond holdings. You receive the absolute share of your proceeds upon selling your bond. The central bank actually remits the proceeds directly to your bank account as is, because also some also sell at a discount. So how do you tax discounts as well? But I think you should also consider consulting a tax expert as well for more advisory regarding tax planning, so that you pay your fair share of tax liabilities.
Okay, thank you so much, Ronnie and Alex, for answering majority of the questions on this platform. I trust that for the questions that you've not received a direct answer, you've probably received an email where you can direct the questions or where you can get more assistance. So I trust that everybody has been well guided. I think in the interest of time, it's best that we close the meeting at this juncture. I have been your moderator, Amy from AIB Axis Africa. Thank you so much for joining our meeting. We'll see you next time.